Hello everyone, welcome back. Here is Ali Talabi. Today we are going to start our second module. This module contains two lessons. First, we'll talk about financial markets. So I will provide you information regarding different types of financial markets we have. And the second lesson, we'll talk about some of the financial firms, or also called intermediary firms. So we'll talk about mutual funds, ETFs, hedge funds. So you will be able to compare them, contrast them, and see the similarities and differences. Let's first start with our different type of markets. So this is the first lesson from the second module. So when we talk about the financial markets, that's a kind of general term we use. However, there are different forms of financial markets, and for sure, there are different classifications for the financial markets. One of the common classification is regarding primary markets and secondary market. Maybe you heard about that before, so let me just make it a bit more clear. So in the primary market, companies are able to sell their shares, stocks, and bonds, and via these markets, they are able to raise funds. This is a key word. So in primary markets, companies, corporations, they are raising funds, so they will get access to pool of funds, so they get money in a very short form. One of the most major, important, and famous primary markets, which I'm sure that you know, it's called IPO, initial public offering. So if it's a company, it's going to the public, or it's going to sell its shares to the public for the very first time, the process is called IPO. Usually it is done through investment banks. So I'm not going to talk about that later. We'll talk about this process. But for now, just let's focus on primary market and IPO. And as you know for sure, through this process, a corporation, they will get access to funds. However, IPO is not the only way which we'll see in the primary market. Another type of primary market, it's called SEO, or seasoned equity offering. So the company, let's say it's been in the business for many years, they already gone through IPO, they already got access to funds from public investors. However, over time, through their operation and functions, they still need to make more money, and they need still to get more finance from shareholders. So any additional financing from shareholders is happening through SEO, or seasoned equity offering. So they go to the already existing shareholders, or maybe some new investors, so they ask them to provide additional money, and in exchange they will give them additional shares. So after IPO, whatever happens in terms of raising funds through shareholders, it's called SEO. Both IPO and SEO are happening through primary market. So as you guess, the second type of market is secondary market. So in secondary market, the already existing shares of companies are traded. And it's interesting to know that secondary markets are usually more famous or more well-known than primary markets. For example, if you look at the NYSE, New York Stock Exchange, Toronto Stock Exchange, NASDAQ, these are examples of the markets for secondary one. So you go to NASDAQ, you look up for IBM or Microsoft, you buy shares of companies. So you're buying these shares from another investor. So let's say I have 100 shares of Microsoft, and I'm selling my shares to another investor with the market price or whatever I'm asking for. So this is happening between two investors. Now maybe you ask yourself, why we have secondary market? Because you know, in secondary market, companies are not raising any funds, and that's true. So primary market should be just enough. We don't need to have secondary market. But remember, let's assume I have shares of Microsoft and I'm not able to sell it to someone else. The question is why in the first place I should have purchased these shares from the company. Because if I know that I'm the first and the last investor, most probably I don't get the shares the first place. So that's the argument. One of the major functions of the secondary market is liquidity. It helps to improve the liquidity in the financial markets, in the stock market, for example. So remember, secondary market, it's called secondary, but actually that's a prereq to primary market. If you don't have a very liquid and a good secondary market, most probably the primary market will be failed in the first place. So these are very interrelated and complementary. We have different other type of financial markets. For example, we have fixed income markets. So we're talking about those markets in which bonds or other fixed income securities are traded. You might have heard about capital markets and money market. The money market and capital markets are related to the maturity or the expiry date of some securities. If the expiry date or maturity date of any security is within a year or less than 1 year, the market is called money market. However, for the longer term, over 1 year expiry date, we call that capital market. So the stock, bonds, those are examples for the capital market. But when you're talking about the treasury bills or short-term money market securities, these are happening in money market. We have other type of markets. For example, one of the most famous one is Forex. I'm sure that you heard about that. Forex stands for foreign exchange. So in foreign exchange markets, so you are buying and selling different currencies. So I'm in the Canadian market, so Canadian dollar, I'm buying and selling US dollar or euro or British pound. So this is happening through Forex. We also have commodities market. So if you are buying and selling wheat, oil, gas, corn, these are happening through commodities market. And the CBOT is Chicago Board of Trade is one of the most famous commodity market which actually can go and buy and sell these type of commodities. Another type of markets are called actually derivatives, and these markets are a bit more advanced than the regular other markets. Why? Because we are using actually more complicated, more complex tools for pricing, for buying and selling, and the concept is a bit more complicated than the regular securities. We call them derivatives. Why? Because these actually securities which are traded in these markets are deriving or getting their value from some other assets which are called underlying assets. For example, you can have options or futures or forward contracts for a specific stock. So these are happening through derivative markets. So these are the major notes which I believe are relevant to financial markets. Please provide me your comments or questions. I'll be more than happy to talk about them. The next lesson under the second module, we'll talk about financial intermediaries or those more specifically, we'll talk about ETFs, mutual funds, and hedge funds, and I will talk about the differences. For now, thank you very much. Have a wonderful day. Here, this is Ali Talebi. Take care. Talk to you soon.